Join Clark Lunt and David Shaw for the Burn Your Boats Timely 10, where they share insights on the latest real estate investing trends, market conditions, and statistics. Stay updated on the industry with these expert hosts and learn how to create wealth through smart investments.
All right, Clark, you ready? We got our mics on this time. We just tried to record our Timely 20. We were a few minutes into it, realized our mics were off. So, Clark, we're going to give it another shot. Our Timely 10 has kind of morphed into the Timely 20.
We can't do 10 minutes, damn it.
Yeah, the name of the game here is to get across a quick real estate or wealth building or burn your boats concept in 10 minutes and just get in and get out. And today we are going to talk about the concept of, instead of being a landlord, being a lender, because it is a super, super powerful thing. Clark, you've been a landlord for 15 years. Tell me about landlording real quick.
So, I've been a landlord since 2007. Geez, so it's that almost 17, 18 years, whatever that is. And it is very much a long game. So it's not instant gratification at all. You don't buy a property and you're rich overnight, or even rich over 5 years. But if you do it in consistency, you will see the fruits of your labor. But it comes with a lot of challenges, David. You've got, depending on if you want to outsource the headaches, which means you have to pay for that, which means you get less money in your pocket, or you can not outsource the headaches and you can deal with collecting rent, fixing faucets, dealing with all the challenges, and you'll get more money, but then you're trading your time for that, and then you need to figure out what your time is worth. And so there's a trade-off that is going to be very personalized. But as you and I both know, there are other ways to create kind of quote unquote passive income. A lot of people call rentals mailbox money. I would push back and say rentals are certainly not just like walk out to the mailbox on the first of the month and get like your check with no other thing. But there are other kind of ways to be able to try and quote unquote get mailbox money. And that's what we're going to talk about today, David. So kind of bring us in as to what that opportunity may look like. And are there things other than buying passive real estate that are still passive where you make mailbox money?
All right. So a lot of investors, they're they understand real estate is in you buy it, you buy the asset, you own it. And there's a lot of advantages that we've covered in other episodes to owning real estate. Great inflation hedge is very, very useful from a tax perspective. You're paying down loans, you're amortizing loans, you're appreciating. Overall, owning real estate is a proven method to generating wealth over a medium to long period of time, right? But we're in a unique time right now, which is why we chose this subject. We're in a very high interest rate environment. And what that means is that if you go out and try and buy a house right now, house prices are pretty elevated. And, have you seen a deal, Clark, that we've underwritten in the last year and a half, maybe even 2 years, that didn't have red ink on it? Like in the real world, not manipulated, not buy down rates, not gimmicks, any of that stuff. I'm talking about a real world deal in a desirable neighborhood,
right?
Where you're going to get that appreciation. I'm not talking about some stuff in the outer suburbs or any of that.
Right.
I'm talking about downtown, core. When's the last time you saw? So you might buy $1 million building, let's say 2 or 3 units in it. You might put down $350,000, right? You borrow $650,000. You take ownership of this property, and for all of your trouble, at the end of that month, you break even if you're lucky. Maybe you make $100, right?
If you're lucky, for sure.
Yeah.
And the other thing too is that to your question is, have we seen anything come across? The only thing that you're going to be able to get is going to have so much risk in it because it's going to need so much capital improvement, so much renovation. You've got some crazy neighbor across the street, which may or may not deter renters from coming in and paying high retail. So are there anything that isn't just super high risk that's going to make any kind of cash flow? That I've seen? Zero, David.
All right. So I've always said, Clark, there's lots of real estates, right? We've just recorded an episode on international real estate, but
Right.
there's 1,000 real estates. There's funds, there's syndications, there's
Yep.
Own the real estate yourself. There's all sorts of methodologies, and there's wholesaling, there's flipping. There's 1,000 real estates. But one of the smartest things that you can do right now, if immediate cash flow is super important to you. So let's say you're in, and what triggered this is I had a conversation last weekend, good friend of mine, 57, 58, he's got a bit of cash on the side, trying to figure out where to put it, thinks the market's over, the stock market is a bit bubbly, and trying to figure out what to do with all of that. He looks at real estate, and he could get some equity. He could buy a fixer-upper
Right.
and get some equity, but you can't eat equity, really, can you?
Nope.
Maybe you get a HELOC, but not in today's money, because
No.
then it's not like the tenant is going to cover that mortgage and the HELOC.
Right.
And so he's kind of like stuck in a jam. And so it got me to thinking about this episode, because this is something that I do. In a high interest rate environment, I want you to think of any piece of real estate, right? You've got a house, right? And then you've got a loan on it, and then you've got your equity on it, right? So in the case that we just gave, like you put down 350, then the bank put down 650, right? Did you know out there that you can be the lender? So if you're sitting on 150,000, 200, 500, a million, there are debt funds and hard money lenders and people out there who do this for you. And so I'll just use round numbers. You can put your money, let's say $100,000, with a debt fund that pays a 12% interest rate every year, right? So that is $1,000 a month. You put your $100,000 down, or no, you put your $100,000 into either in a loan or in a debt fund. You get your $1,000 a month on the first of the month. And here's the kicker: no tenants, no toilets, no property taxes, no roof, no property management company, no insurance dropping you, no neighbors, no drama. On the first of the month, that money is wired right into your account, and it comes every single month, right? And so more and more of the people I know that have done well in real estate over the last number of years that are really focused on income are kind of going into that space, and myself included. And you might say, well, what's the risk of it? Okay, imagine somebody didn't pay you back. When you're in a debt fund, you and other people's money are cross-collateralized across like 100 different borrowers. And the historical default rate in short-term money, let's say hard money, is less than 1%. In some funds it might be 1.8, but that 1.8 is spread across everybody.
Right.
So one person, so let's say the debt fund has 240 loans out there, one person doesn't pay them. They foreclose on it, they get the money, so they're out of pocket for 3 months, 4 months. Money comes back in and it gets regurgitated. So if you're out there right now and you're like, I have $300,000, and what's important to me right now is money that comes into my bank account, and so I could go out and spend it on the second of the month, strongly consider a debt fund, working with hard money lenders and providing them with the capital that they need. Or if you are stuck for some, I know a fair few of these people. I put some money out there myself. Strongly consider this as an option, because the debt is always the last thing to burn. You might say, well, housing prices are going down. Guess what? In this scenario where a borrower puts down 70%, right? In the scenario in a debt fund, everybody puts up collateral, right? So most of these debt funds are taking they're only offering about 60 to 65% loan to cost. So let's say I'm a flipper and I go out and I buy a house for $300,000, and I'm going to put $100,000 into it. It's $400,000, but it's worth $6,000. right? So the debt fund is going to give me the $300,000. It's going to give me 65% of the $300,000 and the $50,000. So in that scenario, the debt fund is going to give me, I'm just going to use a round number, let's say $290,000, right? But then the flipper or whoever it might be will come in and they put a new roof on, they put a new this on, they put a new that on, and they're always every single day getting close to that 600,000. So quite frankly, as a lender, you want the person to default. That's your best case scenario. So then you get essentially a $600,000 house that you only have $285,000 loan on. And so, but meanwhile, you're in a case of, let's say you lend $300,000, you're getting $1,000, or you're getting $3,000 every month. And so if you're sitting on $200 or $300 or $400,000 right now, and you're like, I can't put it on, there's nowhere I can't get an income from this. We're not financial advisors, so don't think that we are, right? Go to your financial advisor, talk about lending, becoming the lender, becoming the bank. But it's something that we're doing every day. And Clark, I know that you're in close contact with lenders every day. In fact, just yesterday, we had a long chat about the cost of hard money and the cost of debt and stuff like that, because interest rates go up. It is the perfect time to become a lender. What do you think of all that, Clark? What do you think of just, I know a lot of people in my circle now who have taken, a lot of their, investment money or their flipping money, and this is hundreds of thousands, if not millions of dollars. And, they're getting 15, 20, 30, $40,000 a month without lifting a finger. So what do you think of that, Clark?
Multiple things. So number one, if you do go to your financial advisor and ask about lending, they're going to absolutely tell you it's a horrible idea because that's not a product they sell. So you can't buy, they're not, unless they want to lend money. Financial advisors are going to more than likely give you tips on life insurance, stocks, bonds, things like that. Lending is not one of the ones that they're excited about. But a couple takeaways that I have. I've seen one of my best buddies lend in hard money to kind of like a quasi fund for 7-8 years now. He works his full-time job. He makes really, really good money. And I know he spends a couple hours a month on this, and he makes 6 figures every year with his eyes closed. True mailbox money. Okay. So I've seen it happen. So the 2 takeaways that I think if you're listening to this is, number one is you always have to make sure that you are vetting, or that you trust the person if you're investing into a debt fund that's vetting these borrowers. What kind of track record do they have? Is this there's a reason why first time quote unquote flippers have very difficult times getting money, and they usually have to put a lot of their own money in the deal because they don't have a track record, because they may screw it up and probably will screw it up. I know I was there on my first few flips. So you have to make sure that someone, whether it's you or the person that you're entrusting in your investment, that they are vetting these borrowers very, very well and making sure that they're still leaving a piece in the deal with the borrower to make sure that your leverage is lower. And then the second thing is that if you've got 100,000, let's use your example, David, of 300,000, the saying, don't go to Vegas with your rent money, holds very true here. Is that if there's any reason that you're going to invest that money in, and for some reason you expect that you're going to have to get it back out quickly, well, if that flip takes longer, or if whatever the reason they borrowed the money takes longer, or worst case scenario is you have to foreclose on them, you may have to sit on not getting that money back for months. And that is not something that, as long as you don't need it, it's not a big deal, because you will get paid back with interest, like on a foreclosure and fees. You'll end up doing better probably if it forecloses, but it's just going to take longer to get to it. So as long as you're not going to Vegas with your rent money in this type of strategy, I think it's probably one of the best strategies out right now to get cash today and not have to overpay for assets or get the horrible examples we're seeing right now of, where you're breaking even on a $350,000 down payment on a multifamily and, fill in the blank city. So if you take those 2 things away from this, I think that it'll be very successful. But it's something that if you trust that borrower, I mean, I know that there have been times I've lost money on deals and I still paid my lender back in full, didn't tell them. It wasn't their problem that I lost money on it, because I wanted to keep the relationship. And the last thing I wanted to do is burn them, because guess what? Then they continue to keep lending. And as long as you're lending to someone like that and you don't need the money right away, This is a great strategy, David.
Nobody in our business, nobody burns a lender. It's
number one
rule of real estate: don't burn your lender, because that lender is a person who facilitates your life. And let me give you an example of who's borrowing money here. So there's a lot of very wealthy people who have a lot of assets. Okay, so let's say you own a $3 million home and you want to move to a $5 million home. All right. And you go to the bank, and the bank will give you, let's say you want to keep the $3 million home, right? And you need to put your down payment down. So you need $400,000 for a deposit, let's say, on a $500,000 home or on a $5 million home. And so you need $400,000. You need it for like 6 months, because you're a sophisticated person. You own this $3 million house free and clear. But all of your money is in businesses, it's in stocks, and if you sell the stocks, you're going to have a big tax event. Yep. And so wealthy people use temporary money all the time. So in the scenario that I've just given you, myself as the lender, I'll come in and I'll take a first position lien on a $3 million house, right? And I'll give him my $500,000. He'll do me a favor if he doesn't pay me back, because I'm taking a $3 million house back, right? And so, honestly, that's the vast majority of this stuff. It's scenarios like that. It's just people who need money for a while, and they have a lot of equity in something. They pledge the equity, and you, the borrower, get to get a monthly income from it. So if you're out there right now and you are, scratching your head trying to find income, strongly consider reaching out to, I could put you in contact with some good folks, and myself included, our company included. And we all use capital. And so if you would like to have a more passive approach to real estate, go and Google, notes. You can buy real estate notes. You can go out and buy mortgages on a secondary market. That's where you buy somebody else's mortgage, but you could create your own mortgages. You can befriend wholesalers or flippers, or you could go to a debt fund, and they tend to be more sophisticated. They're the people who know those millionaires who need just quick cash and they need it all the time. And so I'm using it as a tool to pad out my income as I have, slowed down on flipping. And the reason we're doing this is just quick, timely 10 episode on it, is that it's wonderful. It's less liquid, to your point, but I love it. I absolutely love it. And I've got collateralized positions, and nothing I'm doing could go to zero. And so if you are looking for income out there, learn about becoming a lender or working with a debt fund. It's a fantastic way of getting, monthly income on the first of the month without the tenants and toilets. So with that being said, this is the time to 10. Let's get out of here. 18 minutes, Clark.
There we go. And just remember too, we are creating a community. And so if you heard this episode and you're like, man, that's a good idea, I can actually make cash flow, just reach out to us, like DM us and say, hey, Clark, I love what you guys are talking about, that lending. How do I get involved? We'll hop on a quick 15-minute phone call and figure out hey, maybe we need to borrow money from you to do a deal, or we know someone that needs to, or something like that. So we want to help facilitate this kind of stuff through our own vetted network, so that you're not just kind of going through the yellow pages of real estate to figure this out. So we appreciate you listening. Hit the subscribe button, hit the like button, and David, that's lending. We'll see you next time.
Thank you for tuning in to the Timely 10. Be sure to click the like button and share, and connect with us on social media. Content in Burn Your Boats podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com.